Hi, everybody. Welcome to the basics of fundraising term sheets and shareholders agreements. I'm Justin Pollak from Davis & Gilbert, and I'm here with Charles Toe from ELLALAN, and we're going to walk you through some of the basic financing provisions and from a U.S. and an Asian perspective. Charles, you want to say?
Good afternoon. It's a great pleasure. So Justin, feel free to take the lead.
Sounds good. Ron, can we have the next slide? And this is us. Okay. Next slide as well. So basically what I think we're going to do today is talk through some of the fundamental terms to be negotiated in a financing transaction. We'll talk a little bit about the stage of the first check and how that might work. And then, as I said, we'll give you some of the different perspectives from a US investor perspective and an Asian investor's perspective. So, one place to start maybe is a high-level thought. Recently in VC deals in the US, and I guess recently, by recently I mean over the last few years, interest in venture capital and the amount of money in venture capital has just skyrocketed. And that's led to great competition for deals. And so a lot of the terms that we'll speak about have started to shade towards, being a little more founder friendly, because all of these investors want to get into deals. So certainly, it's not uncommon in the US for someone to raise an entire financing round with just a pitch deck, maybe not even an MVP. As I understand, Charles, that's a little different in Asia.
Yes, it's quite on the flip side. I think the Asian market is not as sophisticated as the VC environment in the US. So it'd be relatively more difficult to raise funds on just an idea. If you just had an idea and you had to raise funds, it would really just be from friends and family. Investors in Asia tend to want to have a product that you could show that works, or even some kind of revenue stream that you show that the model works before investing.
Yeah, and I guess not to overstate how it is in the US, that certainly, as you start raising significant amounts of money, there's an expectation of traction and, some prototype or early version of the business or product. But I do think that, because there's, as I said, the competition and the amount of VC dollars here, maybe it's a little more lax in the US. So let's jump to the next slide, and we will talk a little bit about some of the basic types of securities. As you get into later rounds, all deals are really focused on equity. At an early stage, however, if we're talking about, a friends and family round or even a first institutional round, it's very common to raise your round on convertible notes or safes, another convertible security. So just a quick word on what each of those are. Next slide, please. Convertible notes are truly a traditional debt security. There's a loan amount, an interest rate, a maturity date. The real difference is that on some triggering event, that debt can convert into an equity investment in the company. And so what the notes typically say is, when the company raises an equity round in excess of blank dollars, the loan amount and any accrued interest will convert into equity securities of the company with the same terms that are negotiated by the lead investors in the equity round. with a slight adjustment for the economics based on their proper investment amount. And so the advantage for the investors is that they get to convert either at a discount to the cash round or at a pre-negotiated valuation cap. So if your convertible note has a valuation cap of $5 million, but the equity round is priced at a $10 million valuation, the notes will convert at $5 million to get the appropriate amount of equity. The real benefits for this to the company are that the convertible notes have significantly fewer terms to negotiate. So it's a shorter document, so it can be done quicker at a lower cost. And that works out for everybody because you're typically raising lower amounts in a convertible note round. The challenges here, one, there's no sort of standard form, which you'll see we kind of talk about in later. But also, since it's a traditional debt security, there is a maturity date, and that presents some sticky situations for both sides. Because obviously, when that maturity date comes, it's unlikely for the startup to have the cash on hand to repay it. And then the flip side, investors can be nervous that at maturity, they could potentially be repaid if the company is, on that proverbial rocket ship, and they maybe do have the cash on hand, or they can bring on new investors to take them out. So again, maturity presents a problem that can be addressed in a couple of ways, but that is kind of one of the drawbacks of a convertible note. Charles, are these common in Asian markets? Do you see notes a lot?
I think more sophisticated investors would ask for convertible notes, but I have to say around 30 to 40% of the deals that I do actually don't, investors or the company, they don't even negotiate any convertible notes or safe notes or even preferred equity. They just go, especially in the earlier rounds, they just go straight in with ordinary shares.
Yeah, that's less common here, but I guess I understand the logic. Certainly at early stages with low valuations, even if you were to have preferred equity or something, their interest, but by the time the company matures, those early stage investors have interest more aligned with the founders than with the later stage investors sometimes. So let's jump to the next slide. Charles mentioned safes or safe notes. A safe stands for a simple agreement for future equity. They're very similar to convertible notes in that the company gets cash today with a promise to deliver equity at some point in the future, typically, on an equity financing. But the principal distinction between a safe and a convertible note is a safe doesn't have those debt features. They don't usually have interest rates, but sometimes, and there's no maturity. The safe investors, when they convert, just like a convertible note, will get the same terms, same rights as the equity investors in the financing rounds. And similarly, the economics are adjusted for the amount that the safe investors invested at. Also with a cap or a valuation, also with a discount or a valuation cap. Similar benefits, really easy to negotiate and manage your legal expense. Most startups that I see use the standard Y Combinator form of safe or something that's very close to it. So it's really, the terms are almost pre-baked for you. The challenge is that safes can remain outstanding without converting for really ever if the company never does a traditional equity financing. And safes give you economic rights in the company, but you don't get any of those governance or management rights, which certainly institutional type investors want and expect, to specifically to sort of help keep the provide value to the company as it grows. Charles, any Asian perspective on safes specifically?
It's quite interesting, actually. One thing I thought of, given that, I mean, it's not unknown about like convertible notes and safe notes in the US. There are actually a number of deals where I see clients coming to us and they've already signed certain convertible notes or safe notes based on US templates that they downloaded, but for a Hong Kong company. But obviously, not being a lawyer, they would have used those templates straight out, and making references to US Securities Act, California law, and for a Hong Kong company which has no US relevance.
Right.
So yeah, just an interesting note.
And so in that situation, obviously, we certainly think that all startups and investors should talk to their lawyers early and often. But in a situation like that, does that, apart from sort of additional legal expense to maybe clean up that documentation, is there material harm to the company?
I mean, in most cases, it's fine because, I mean, at those early stages, everyone is still very harmonious, and everyone's happy to make any rectifications and just sign new documents. But there are situations where even at this stage, there would be disputes between the early investors and the founders, or even among the founders. And sometimes the terms within these documents do pose a difficulty as to how certain terms should be interpreted.
Yeah.
And often it ends up that the parties have to somehow reach a settlement.
Yeah, I could see that being a problem. The other thing that you touched on is sort of the reference to the US securities laws. Those are necessary here to raise money. Is there something, are there similar securities type laws that startups or investors need to address in, Hong Kong, for a Hong Kong-based
Obviously, Hong
company?
Kong has its own securities laws. Usually, references are not necessary in the documents. I think it's more on the fundraising aspects, on how it's carried out. That when you're raising funds, you're only you're not doing it to the general public. Otherwise, there are local legislations which prevent that from happening, and if you breach it, it's actually a criminal offense.
Okay, that's a little harsher than it is here, but similar idea. Okay, so let's jump to the next slide. And so, for both convertible notes and safes, we mentioned how they convert into equity, but what does that really mean? And so preferred equity is a true ownership stake in the company. You get a number of shares that represents whatever percentage you own. Equity gives you, and I guess, as I mentioned, equity gives you both the economic rights. So when the company is sold, you get your share of those proceeds, but also governance rights, typically as a class. So that means, one, the right to elect directors, and the right to vote on or consent to certain significant transactions, like an exit, or a subsequent round of financing. And so it's kind of those governance and control rights that you don't get with a convertible note or a safe. The reasons that convertible notes and safes gained in popularity is because when you're talking about all these governance rights, that just creates a lot of terms to negotiate. And then that means a lot more legal time and higher bills. So doing a preferred equity round, at least in the US, is typically a more costly experience than a safe round or a convertible note round. And I guess the last point that's up here is when you get your equity, your valuation is fixed, so it doesn't change with the next financing. Your share, if you invested $1 million on a $5 million round, you'll wind up with I guess it would be a 6 million post, 1/6 of the company. So that's what you get on the day of closing. You continue to be subject to dilution by future financing rounds, but your stake, at least as of that date, is fixed. So Charles, you mentioned a lot of early rounds are done with just ordinary shares, or I guess what we would call common stock here. Preferred equity, is that still when you get into slightly later rounds? Is that still the principal security?
Yep. I think one interesting point to note is a lot of both company and investors, they know that, okay, I want a preferred equity. And they were like, yeah, they've negotiated that they'll get preferred equity. But we're like, okay, so what are the terms of your preferred equity? They go, oh, I just want preferred equity. And you start asking them, you start asking both parties, so what are the terms? And neither party could tell you what they really want. And then you end up have to go in and explain what the significance of each term is. So I agree that a lot more negotiation has to take place.
Yeah. And so I guess one point that I guess we didn't mention on the slide is the distinction, the principal distinction between preferred equity and common equity is that preferred equity has a liquidation preference. Means some amount of money gets paid out to the holders of preferred stock before it gets paid to the holders of common stock. And so there are a number of variations on what this can look like. You can have participating preferred, where a preferred stockholder gets a fixed amount per share before any money goes to the common. And then once you've cleared that preference for all preferred stockholders, the common and preferred share pro rata. Or you could have what's called non-participating preferred equity, where the preferred stockholder gets the greater of their fixed amount per share, or what they would get on a pro rata basis out of the proceeds of the sale. So that gets into the economic rights of the preferred equity, and then additionally you have the governance rights. Charles, what do you see in terms of preference commonly?
It really depends. There's no set standard at all. You would see situations where the investors have a lot of bargaining power and they want a 200-300% return on the liquidation preference. But on the other hand, there are situations where we're told by the founders that, yeah, we're going to issue preferred shares and preferred equity. And I said, what are the rights? And it turns out that these shares actually have less rights. They basically have the same rights as common shares in terms of liquidation, but they have no voting rights. Interesting.
Yeah, that's different here. I guess on both accounts. The US is a little bit more down the middle. I think what you most often see here is a 1x non-participating preferred share, unless you're talking about a sort of distress type situation, or I guess somewhat aggressive investors. On occasion, I still see participating preferred, but very rarely more than 1x, unless it's like a real distress type situation. And then on the downside, investors, at least what I see more almost always, is investors get certainly voting stock, and maybe they have pared back negative controls or consent rights, but always something. So let's go to the next slide. And here we're going to talk about, how are all of these rights communicated and set forth between the founders, the company, and the investors. And that gets into the legal documentation. Charles, I know this first bullet point is one that is important to you, so I'll let you get into why the legal agreements are necessary.
Yep. I cannot stress enough to clients that even if there's just two founders when you're starting off a company, why it's important to have a founders agreement or shareholders agreement controlling how the company should be managed, or how the board should be ran on a daily basis, or if there are disputes, whether there are deadlock clauses and whether they are drag along and tag along. Without these clauses, it's often, unfortunately, that the shareholders down the road would enter into disputes. And we've dealt with various situations where siblings who started a company together ended up suing each other for more shares. It's usually the situation where two or three friends get together and they're like, yeah, we'll just have equal amount of shares. And then as the company grows bigger, those it could be worth a lot of money. And then there would be obviously someone who says, well, actually, I contributed a lot more to the company, so it's not fair that you're getting the same amount as me. And then without a agreement in place, people would go to their lawyers and say, well, is there anything I could do to show that actually I have more control of the company, and then these shares are actually held on trust for me? Or they'll when money is involved, you just get a lot of ugly situations. So it's very important for these agreements to be signed right at the beginning when the company is actually not worth much.
Right. It's important to stress that, that at the early stages, the companies are not worth much, and 1% here, 1% there may not mean anything. But if you fast forward a couple of years and a couple of financing rounds, if you're talking about a unicorn or even a decacorn, 1% is real money, and people would certainly fight over that. So it's very important to get those arrangements down on paper at the start to avoid those later fights when there's a lot more at stake. What I would say in the US is I don't typically have clients who do shareholders agreements when it's just two or three founders, but we do put language together in either, you have the bylaws, you have the certificate of incorporation, and also for what I think is most important there is to make sure you get vesting arrangements in place to protect the founders almost from each other. So, if one founder decides to leave, they're not taking 50% of the company with them, and then the other founder has to manage the company basically with half the equity to work with. So again, that's certainly stresses. I guess we're lawyers, so obviously we think these are incredibly necessary, but you can understand why. As for timing, as we both mentioned, as early as possible. The longer you wait to put these arrangements on paper, the greater the dollar value of the issues, and the more people are willing to fight over them. So it's a lot easier. The negotiations go a lot smoother before the company is worth, let's just say, real money. And so, Charles, anything in addition to add to sort of what types of documents to be prepared? You did kind of get into it.
I would say it's really the shareholders agreement. And other thing, I mean, if we're talking about just documentations needed, not directly for fundraising, but it's, I mean, with startups, often the most valuable asset is the company's intellectual property. And it's very important that the founders or employees or any contractors have actually assigned its intellectual property ownership to the company. I mean, when we do due diligence deals, I mean, this is one particular document we do look for. Or, I mean, whether it's a separate document or whether it's a clause in your employment agreement or the founders agreement, it's important that it's there.
I would echo that wholeheartedly from a U.S. perspective. That's, I think when we do diligence on early stage deals for an investor, the two things we look at, one, are making sure that cap table is properly documented so we don't have these founder issues, and two, IP, making sure whatever it is that the company does, it has the proper rights to do that. Both making sure that that's documented from the founders internally or any outside consultants or development shops that they might have worked with. That's a really, really good point. So let's jump to the next slide and we can talk a little bit about what terms you actually might start to see. So in the US, there's sort of a subset of terms that have become more or less standardized. As I mentioned, there's the Y Combinator safe. Here's a link to it for those safe type raises. We also have the National Venture Capital Association, or the NVCA. It's an industry trade group that does a lot of work for the VC industry and VC funds in general. I think the way at least most lawyers know about it is through their model legal documents. Again, here's a link to it. It's a library of documents. Principally, there are documents to use in a financing transaction, but they also have standard policies and other things that a startup might need. And so I highly recommend checking those out. And then the Series Seed documents is another somewhat standard, less common set of documents for earlier stage investments, maybe somewhere in between a SAFE and an NVCA style financing. And so sort of going with that NVCA model, which is what I definitely see most often, you'll have a purchase agreement, you'll have an investor rights agreement, you'll have a voting agreement, you'll have a right of first refusal and co-sale agreement, and you'll have the company's certificate of incorporation. It's a little confusing to have all these rights spread across 4 or 5 documents, but having these sort of standardized models makes it easier to negotiate these transactions. Charles, I understand it's sort of less standardized in Asia.
Yeah, there's no in Asia there's no industry standard per se. So I mean, if it's drafted by lawyers, typically it would be 1 or 2 documents that includes all the necessary rights.
Mm-hmm.
That's fine. I mean, that's what we typically do. The difficulty comes in, as I said, it's when clients have previously adopted some templates. It's great US templates, but they try to amend some clauses and it's typically not usually amended well. And then they don't amend some clauses. It just gets very messy and then you get into a large dispute as to what the documents actually mean.
Yeah. Yeah, that happens here too. We certainly get clients that kind of play their own lawyer sometimes, and sometimes they do it well, and sometimes they don't do it well, and it winds up um, taking more time to clean it up.
Yep.
So if we could jump to the next slide. Here's just a basic list of the typical terms that you would see in a term sheet and that are ultimately going to get put into those longer form definitive documents. We could just touch on these. Valuation is probably the most important and most focused on term on the term sheet. Really, that's the price that the investors are investing at. It varies by stage and by industry, and maybe that's the one part that is kind of less standard than the rest. Option pool is also something that's very commonly put into a term sheet. This talks about the number of shares that you set aside to be issued to employees. It's important to founders and to investors first because it plays into the negotiation over valuation. If you have a bigger pool, then everybody who invests in that company is going to get less for the same valuation. But it's not that investors want the option pool to always be small. They want to make sure that the option pool is the right size, that the company can issue equity to its employees so the company can grow on the path that everybody wants it to. They just want to make sure that the dollar valuation matches the equity share they're going to get. And then liquidation preference, we kind of touched on before. This is whether it's participating or non-participating, if there's a multiple, because those really get at the economics of the deal. Anything else that goes, Charles, from your perspective, that really goes to the economics of the deal?
I think it's the valuation. As I said, investors in in Asia or Hong Kong typically don't really have an agreed way to value startups.
Yeah.
So, I mean, you could do comparisons of comparables, or sometimes they'll be like, well, I want my money to increase by 5x in 2 years. So what should my valuation be now? It's really a commercial decision which lawyers typically don't get involved with, but often we do get asked on our views.
I would agree with that, yes. Yeah, and it gets tricky at early stages too when you're talking about a seed or a pre-seed round, and you're trying to figure out what the right dollar value is. Again, sometimes you can address this by using a convertible security where you can kind of push the decision on valuation down the road a little bit. But it certainly is going to come up at some point. The one note I guess I would add there is oftentimes, at least in the US, institutional type investors will have minimum ownership thresholds that they need. Certainly for an early stage investor who knows it is going to be diluted as the company grows, that investor may just feel very strongly that it has to get at least 15% or at least 20% of the company at the seed stage to make sure that it has sufficient economic rights going forward. And then sometimes you can use that ownership threshold and the amount of money that the company needs at that time to kind of back into a ballpark valuation. But oftentimes, it's not that simple. So the next level, I guess, of term sheet terms really get into control. And the first place that I would look to that is on the board seats. In the US, a corporation is owned by the stockholders. The stockholders elect a board of directors who control the direction of the company, and the board of directors appoint officers, and the officers handle the day-to-day operations. So the most fundamental level of control is the ability to appoint a director. In most financing rounds, the investors will get to appoint at least one member of the board of directors. Sometimes at a seed or a pre-seed stage, the investors won't push for that right, but certainly when you get to a Series A and beyond, that's always an important part of the transaction. The negotiating point there is often around when the founders lose control of the board. So at a seed or a Series A, you might still have 2 founders and 1 investor on the board. As the company grows, maybe it's in the Series A, maybe Series B, maybe later, investors may outnumber the founders and founder appointees to the board. And then obviously there are certainly high-profile cases where the founders continue to control the company and control the board as they go on, but that's really where the negotiation happens. Charles, what do you typically see around board seats and board control?
I think it's similar to what you mentioned. I mean, there's not much big variation in Asia for that.
Mm-hmm. Okay. Yeah. So then just going across this row here, pro rata rights or preemptive rights are very common kind of at all levels of all stages of financing. Investors always want to be able to participate in the next round and the future rounds. And at early stages, I think companies are very willing to give those. As the company grows, you just don't want to have too many investors that you have to go back to for every financing round. It becomes an administrative challenge, and you potentially block out a later investor who may have an ownership threshold or a dollar investment threshold, and then you wind up with unnecessary dilution that people don't necessarily want to take. Nevertheless, it is something that investors do focus on. And then I'll just touch on registration rights. Registration rights in the US are the investor's ability to force the company to register the investor's shares. And when I say register, I mean make them able to be sold on a public market. I'll take a quick digression here. What we're talking about, certainly in the US, are all private company investments, not the shares that you can buy on the NASDAQ or the New York Stock Exchange. But the ultimate goal, I guess that's maybe debatable, but one potential exit for all these companies is to become public, whether that's through an initial public offering, a direct listing, or you may have read about SPACs that have become very popular recently. Once the company is public, then an investor can freely sell its, once a company is public and its shares are registered, it can freely sell its shares on a public market, on the NASDAQ or the New York Stock Exchange. Until that point, they can only be sold in a private market transaction, and presumably because there's less information out there, fewer buyers, you're not going to get as high of a price or as accurate of a price for your shares, potentially. So, Charles, any thoughts on pro rata rights and or registration rights from an agent?
Pro rata rights, it would be in every single agreement or term sheet. Registration rights, it's typical more for the US deals. If it's a pure Asian deal with no US investors, it's typically not asked for.
All right. Yeah, I think.
I think when actually one point when you talked about the ultimate goal, I mean, actually we might deal with that on the next slide, so I'll leave that point.
Yeah, registration rights. Just as a side note here, registration rights can be burdensome to negotiate, and so oftentimes at an early stage, certainly on a pre-seed or a seed stage deal, even with the benefit of some of the standardized terms that we discussed, there's still a lot to talk through. And when you're talking about a seed stage company, any IPO or direct listing, whatever you might have, is still pretty far off. So I at those stages, I like to try to avoid negotiating registration rights until a later round. Even if you do negotiate them, they're very often kind of thrown aside once the IPO process starts and the underwriters get involved. So they're certainly important. They're certainly something that investors look for, but I think less important at the early stages. So the drag along rights, Charles, you had touched on this earlier. Do you want to get into what this is, what drag along rights are, and why they're important?
Yeah, I mean, drag along rights are typically, I mean, will be dealt with the right of first refusal. So the two bottom points. It's basically one's for the majority shareholders benefit, and one is for the minority shareholders benefit. So drag along rights, it's when once a certain threshold of shareholders, let's say 70-80% of shareholders want to sell the company together to a third party, they actually have the right to drag along, so make the minority, like remaining 20% shareholders, sell their shares together on the same terms to the third party. The main purpose of this is there could be times when a third party buyer wants to acquire the entire company and not just 80 or even 90%. And you need to have this drag along right so that you could basically sell the entire company without some very minority shareholder trying to block the deal or hold the other shareholders at ransom and ask for a much higher valuation on their shares. And similarly, on the next point on right of first refusal, it's when and co-sell. So it's when the minority shareholder, so a tag along, right? Typically often called, it's when the minority shareholders don't want to be left in the company. So let's say 80% of the shareholders are selling to a third party, and they would be like, I want to get out as well. I don't want to be stuck at this company with this third party who may never buy my shares or look for further investments to buy my shares as well. And if they don't buy the minority shares, then they're not allowed to proceed with the deal.
Yeah, in US VC style deals, the one nuance related to right of first refusal and co-sale is it's typically the founders of the company are subject to a right of first refusal and co-sale rights in favor of the investors. So if the founder wants to sell some portion of his or her shares, he or she basically has to offer them to the investors first. And then similarly, if the investors either don't want to buy those shares because they're not interested in buying them or because they think the price is too high, they would have the right to sell their shares alongside the founders' shares to this new third-party buyer. So it serves as a minority protection as well, but it also is a little bit of a control mechanism to keep the founders focused on this business rather than basically selling out before the investors can. So we touched on exit. Let's go to the next slide, and we'll talk a little bit more about exits. Could we get the next slide? Exits. And so exits can take a number of forms. We already mentioned IPOs and some of the other ways to go public. It's probably significantly more common to be acquired. And so, Charles, I know you had some thoughts here.
Yeah, so obviously long ago it would be typical for companies wanting to exit by IPO. But nowadays, especially in Asia, I mean, a lot of companies build themselves out with a view that they would be acquired by Tencent or Alibaba, so the BAT or Facebook. So yeah, that's one significant exit point for a lot of companies.
Yeah, and that's the same here. Certainly the overwhelming majority of exits are through acquisition. Certainly in the last 6 months to a year, you've seen a lot of very high profile IPOs that have gotten very popular. And it's certainly still an option and a goal for many companies. But it is a longer path to get to IPO typically. And it is typically only, really those companies that reach the highest valuations. And so I still certainly see M&A as the more common exit across the board. And so in terms of timing, I don't know that there's any specific point in the US when it's right to exit. I think the right time is when you get an offer that you like. And certainly there are times where companies will face some decision point where they either need to raise a significant another round of financing or find an acquirer. And so maybe that is a decision point for them. But maybe in Asia, there's maybe more of a specific point.
Yeah, I don't think there's a standardized right time to exit. It's really what the founders want, or even, I mean, well, it could be that individual investors, VC firms, they would want to, let's say there are some VCs who invest in very early stages and their aim is to exit at Series B, Series C round, and they don't plan to wait till IPO.
Right. Yeah, that's true. You'll often just have early investors that are willing to take some guaranteed return at some point rather than waiting out an IPO or even an acquisition if it's going to be years more down the road. And sometimes the life cycles of VC funds play into this as well.
Yeah, I mean, especially in light of like recent year of COVID, there's actually quite a number of startups where I've seen early investors have said, well, actually, if I could get what I've invested back, I'm happy to exit, because they needed the cash to fund their other main business.
Yeah. I think typically in the US, getting your money back is viewed by a VC as not a really successful exit. But in as you noted, in sort of COVID times, a lot of those perspectives have changed.
Yep.
So I guess the next slide. I think that takes us to the end of our presentation today. We are happy to take any further questions that you guys might have.